Hey guys, I'm Becky and welcome back to my channel. So today with Enduring Finances, we're going to be taking a look at what inflation is and how it impacts the value of money today versus tomorrow. So what is inflation? Inflation is the impact of rising prices paired with the buying power of money decreasing over time, meaning a dollar is worth more today than it's going to be worth tomorrow. So let's take a look at 50 years ago. In 1971, $15.22 had the same buying power as $100 did in January of 2021. A gallon of gas in 1992, almost 30 years ago, was only $1.08. In 2021, the average price for a gallon of gas was just over $3 a gallon. Now with inflation, not all products and services are impacted the same. It's not a flat line where everything increases the exact same value year after year. It varies based on the product and what's in demand and what's in shortages in a year. So we can look at used vehicles for this last year. We can see that it's jumped up almost 20, 30, almost 40% on the worth of used vehicles. Why? Because demand is so great because production has been so low for new vehicles. But the dollar value hasn't matched that price increase, so you're losing money if you buy a used vehicle for more than it's worth. The overall inflation rate for 2021 was over 6.8%. It was closer to 7%, meaning that $93.82 in January of 2021 would have the same buying power as $100 did in December. So, in that 12 months difference, the buying power of $100 lost $6.18 in value. So let's look at it in a bigger perspective. So let's take a look at a $40,000 salary. So last year you made $40,000 and it had $40,000 worth of buying power. If you were to compare that salary to the same year with no increase whatsoever, you would only have $37,528 in buying power based off of how much the prices of goods and services have increased in the last year, which is not anything that anybody wants to see. So how does inflation impact investment returns? Well, in 2021, I earned $98.26 from a high-yield savings account. It took 12 months to earn that return on about $5,000 in that account. All in all, my bank account earned less than 2.5% for that year, meaning I lost money by just having cash sitting in this bank account all year. Why? Well, because the buying power of $100 decreased by over $6 last year. My meager return of less than 2.5% did not even match the inflation rate, which means I lost 4.3% of the buying power of that $5,000 last year. Now keep in mind, there's a caveat to this. It's there intentionally. That $5,000 is my emergency fallback fund. It is there for worst case scenarios in case I do need it in an emergency situation. It is not where I keep all of my retirement investings or anything like that. So there's a purpose to that. I'm not just losing money because I don't know better. So let's take a look at my actual investment accounts. In the month of December of last year, I earned $93.90 in just dividends in 1 month. Now that's from my $30,000 brokerage account. In total, my stock portfolio returned just under 22% between the dividends that I earned every single month and just the overall growth of the individual stocks in my portfolio. Meaning that my money was making money while I was sleeping very peacefully, even with the high inflation rates. So what does this mean for investors? If you think that just saving money in the bank is a long-term answer to retirement, you need to think again. Inflation is the silent killer of any monetary gains. Not only did the $5,000 in my bank account actually lose value due to the inflation, I also missed out on the money I could have earned. Not could, I would have earned if I would have invested that into a brokerage account or one of my retirement funds. That opportunity cost, or should I say the missed opportunity cost, really hits home. When it comes to long-term saving and investing, you need to be smart with your diversification strategy. If you're not at least keeping up with the inflation rate with your returns, you're losing money every single year. Be cognizant of how inflation is going to impact your cost of living in the next 20 or 30 years. Now, the average inflation rate is usually about 2.54% annually, but we also know from the rule of 72 that in less than 30 years, your money is going to lose more than half of its buying power. So you need to start investing as soon as you possibly can if you're not already doing so. Remember, the more time an investment has to grow and compound over time, the greater return you are going to see. The first 100,000 is always the hardest, and then it just gets smoother and smoother from there. So start investing as fast as you can, make smart choices that align with your retirement strategy and where you're going to be at in the next 5, 10, 20, 50 years from now, and make sure that your diversification strategy matches the risk that you're willing to take at this stage that you're at. I'll see you next time, guys.